What's up, traders, and welcome to part 2 of our look at the U.S. Trade and Fed Actions tab of the Market Barometer software. In this video, we're going to be talking about the total public debt and the debt to GDP ratio, which are macroeconomic indicators that we use to get an idea of the main trends moving the market. It's also going to give us an idea of the kind of health of the U.S. economy and likely future direction of the economy and the stock market. So without further ado, let's dive back in. So that brings us to the total public debt and the debt to GDP ratio. Now I kind of lump these two metrics together and I look to them as further clues and indicators of kind of what the Federal Reserve is up to, of kind of what the Fed is up to, and what the implications of the decisions that they're making are going to have on the short-term and long-term economic outlook. So generally speaking, the total public debt is just the sum of accumulated outstanding debt owed by the federal government to the public and intragovernmental departments such as Social Security. So in the short term, public debt is kind of a dual-edged sword. In the short term, it can have a stimulative effect on the economy because debt is generally used to invest in economic growth. In the long term, if total public debt accumulates to be too much and too great, especially as a percent of GDP, it can weigh on a country's ability to invest in economic growth. Particularly because, as the debt grows, the interest that is owed on that debt also grows. And if there's a high debt to GDP ratio, meaning, there's more debt relative to what a country is producing every year, it's going to be harder and harder for a country to meet those interest payments. And generally, it's going to increase the risk of default of a country going bankrupt, right? Also, if the debt load becomes too great and there's too many interest payments associated with that debt relative to a country's GDP, more of a government's revenues are going to be going to servicing old debt as opposed to investing in economic growth going forward. So this can spell trouble for the long-term health of an economy. Looking in the market barometer here, we can see the trend in total public debt over the last 25 years or so that we're looking at here. Total public debt has trended up and to the right significantly during this time and has really picked up steam in the last decade and especially in this last year. So public debt trending up through time. It really started to pick up steam after the Great Recession. You can see the public debt at that point started to skyrocket. And then again, in the wake of the coronavirus fallout here in early 2020, you can see the public debt has spiked once again. So that's an indication that, our debt problems aren't going away anytime soon and that the government continues to pile on debt in an effort to stimulate economic growth. So right now, what this chart's telling me, the total public debt chart down here on the bottom left of the market barometer, it's telling me that the government's okay, that the Federal Reserve is okay with taking on more debt in an attempt to stimulate short-term economic growth. So similar to public debt is the debt to GDP ratio. And this is going to kind of put that total public debt in the context of what the United States is producing every year. And give you an idea of the United States' ability to meet the debt obligations associated with the public debt. So, coming back to our PowerPoint here, generally a small amount of debt and a healthy debt to GDP ratio can be good and stimulative for the economy. Whenever that debt to GDP ratio grows too big, it can be a burden, especially on the long-term health of an economy. So generally the tipping point of a healthy debt to GDP ratio is about 77%. When it climbs above that, a country starts to run the risk of not being able to meet its debt obligations. So, looking back to the market barometer here and the debt to GDP ratio in the bottom right, you can see kind of troubling signs for the current situation as far as the debt to GDP ratio for the United States economy. basically since 2012, 13, we've constantly been running a debt to GDP ratio above 100%. So kind of an unsustainable level moving into the distant future. Kind of an unsustainable level moving into the distant future. But what this is telling us is that in the short term, there's more public debt accumulating, and that's probably going to be a short-term tailwind for the economy. So there you have it, folks. A quick look at some of my favorite indicators of the health of the U.S. economy. By way of the U.S. trade balance, the kind of Fed balance sheet and money supply, as well as the total public debt level and the debt to GDP ratio. Again, each of these pieces of information gives us another clue as to the health of the U.S. economy, the potential future direction in both the short and long term of the U.S. economy, and the strength of the U.S. consumer. So if you guys like this video, go ahead and smash upon that like button and subscribe to our channel. Stick around for future tutorial videos to learn more. Also, you can visit us over at marketbarometrics.com to learn more about all things technical, fundamental, and macroeconomic analysis. Thanks, and we'll see you guys in the next video.